Good morning, ladies and gentlemen. A very warm welcome to the 8th edition of Metal Outlook and Market Trends 2016 from the House of MMR Events, an affiliate of Braj Binani Group. My name is Tito Ipin, and I'm the Associate Editor of MMR Publication, and you have to bear me till this evening. Uh, Before I proceed with the sessions of this 8th edition of Metal Outlook, I would like to give a brief outlook about our publication. I know you are all familiar with our publication, which is founded in the year 1948, and in this 68 years, we have become the voice of the metal industry. And absolutely, this is something to cherish, but with great responsibility. And the responsibility is the outcome, what we have come up with this event. And I'm really proud to say that in these 8 years, Metal Outlook and Market Trend has become one of the most anticipated show of the metal industry. Our very rationale to provide and to come up with this event was to give a platform to the metal industry where the industry captains and the market analyzer, the researcher and the producer and end user can come together and dwell upon many crucial aspects pertaining to the metal industry. Today, I'm very delighted to see a very powerful presence of professionals from the wide verticals of metal industry, and I believe and I hope that today we will dwell upon many critical aspects. I welcome all the dignitaries, delegates, and the authors for the 8th edition of Metal Outlook and Market Trends 2016. Now, I request Ms. Beena Verma to come up on the stage and formally address the audience with a welcome notice. Thank you.
Thank you, Mr. Titu. Dear ladies and gentlemen, we are back after 8 years again and with the same team to take it further. And it gives me a great pleasure to extend you all a very warm welcome on behalf of MMR Events, a division of Braj Binani Group, and the organizers of today's seminar. Please allow me to express how grateful we are to you all who have accepted our invitation to convene this seminar for the metal industry. I think this seminar is an opportune time to renew contacts and discuss issues of mutual interest with our industry folks. It is gratifying to note that the agenda of the seminar covers a wide range of very interesting topics for discussion, which will eventually help us in determining the action plan in India for this very crucial year, that is 2016. I will give bit emphasis to India and to the year 2016, since both will play a crucial role in consolidating the global metal market. The fact of the matter is that since the last 4 years, the global metal industry, specifically the steel sector, has been floundering, and it's been tough for the producers to find any silver lining. Now with 2016 upon us, the one question that has been asked by everybody, even as prices plunge and the Chinese economy shows no signs of recovery, is what now, what next? The unanimous response from around the globe and India. Even if there's unanimity in India, but what we need to find in this seminar is when and how the largest democracy will deliver. Yes, of course, we will all know that India has a huge unfilled demand and even bigger economy. But when will the benefits start accruing? That's $1 million question now. So as media and the event organizers, our task is to give a platform for the industry to scrutinize where we are standing today, where are we heading towards, and how can we make the year 2016 the most fruitful in the filling those vacuums in India. Dear friends, we are delighted to provide a space for the industry captains and policymakers for a brainstorming sessions today. We are here with the 8th edition of Metal Outlook and Markets 2016 to dwell upon the critical issue of metal sector, and I am confident that this seminar will give the intellectual and analytical atmosphere whereby we can think of creating a robust road map for our metal industry. Thank you, ladies and gentlemen, for enabling us to create such a scholarly gathering with your valuable presence for this bumper event. I welcome the gathering of quality and industry fellows. At the same time, I take this opportunity to express my heartfelt thanks to all our illustrious honorable authors for accepting our invitations, even though they have been very busy in their schedule, but they have taken time out to share their expertise with us. We truly appreciate your dedication towards the industry. I would like to express my sincere gratitude to our dear friend Mr. Chandrasekhar for his enthusiastic support and guiding us for making this seminar a reality in all these years. He has been the driving force, friends, when we started this seminar. How we need to make this annual. In fact, he foresees that we can make it quarterly and biannual. Let us see if we can do it with the support of all the sponsors. And of course, Mr. Naveen Mathur, who too has been with us for last 8 years, and he has never turned down the invitation to be here and share his valuable expertise with us. And of course, we are going to be waiting for Mr. Firoz, who is on the way, unfortunately misled by the driver. So by the time we start the discussions, he'll join us. And welcome to you all, distinguished guests and our delegate friends. Again, this seminar could not have been possible without the support from our dear sponsor friends, which I'm sure will be more generous next year, and the hard work of my dedicated team of MMR, which may not be it is visible, but the kind of efforts they have put up, maybe the gathering of 120, but it's a gathering which is quality gathering who mean business to us. We are grateful to all of you and for all those who have shared in today's grand success. Thank you very much. Have a nice, fruitful deliberations for the days. Over to Mr. T2. Thank you.
Thank you, ma'am, for such a wonderful insight. And now we are moving towards a very inaugural session of this 8th edition of Metal Outlook. And I have with me Mr. G. Chandrasekhar, who will be chairing this session. And he has been very instrumental in formalizing and framing and shaping this event for all these years. Along with him, joining for this session is Ranjini Sinha, Senior Economist, Aditya Birla Group. Welcome. Naveen Mathur, Associate Director, Commodity and Currency, Angel Commodities. Dr. A. Firoz, Chief Economist, Joint Plan Committee, Ministry of Steel, who will be joining shortly. And Kunal Shah, Head of Commodity Research, Nirmal Bang. Welcome. I request the panelists and the chairperson to come over the dais. Ladies and gentlemen, this session is specifically dedicated to the micro view on metals, demand, supply, currency, policy and pricing. And this will help us in understanding how currency, policy and pricing plays a crucial role in determining the market dynamics in the domestic and global market. And I request Mr. G. Chandrasekhar to proceed with the session. Thank you.
All right, I'm truly delighted to be back here. This is the 8th edition, and I guess I've been a part of this in all the previous 7 editions. And I'm delighted to be back here again in this 8th edition. Naveen, I'm sure has been with me on all these editions, and I'm sure Kunal last several of them. Anyway, this is not going to be a panel discussion again. It's going to be individual presentations. But at the end of it, each one of the experts here will be able to take questions from the delegates. Very clearly, we live in a VUCA world. VUCA is what everybody's talking about. I guess all of us know what VUCA is all about. Volatility, uncertainty, complexity, ambiguity. That is what is VUCA all about. And that's a kind of economic life every nation is leading. That's the kind of economic life every businessman is leading. And I think in this situation of volatility and uncertainty and complexity and ambiguity, we need to find some sense. We need to crystal gaze into the future. What's the emerging scenario? Why are we in this place today? And what is our journey? Where are we going? Where would we be going? And what should we be doing to continue our journey successfully? I think that's obviously the purpose of this seminar, I guess. Firoz, yeah, please come, join us. All right. Okay. The first slide, please. Can I do I have it here? All right. I'm quite fond of using this slide, which I've used in different parts of the country, in different parts of the world, when I talk to commodity market participants. There are 5 major or key drivers of global commodity markets. And all of us in this room, all of us who are stakeholders in the commodity space, whether you're a producer, you're a processor, you are an industrial consumer, you're an importer, exporter, trader, intermediary, whatever you are, you need to track these 5 major global drivers which impact the commodity market. The first one is, of course, economic growth. There's a strong positive correlation between global economic growth and commodity consumption. And when we talk of commodities, we cover energy products, we cover all metals, and we cover agriculture commodities, and of course polymers, plastics. And therefore, positive relationship between economic growth and commodity consumption. Higher the economic growth, higher the possibility of commodity consumption. And therefore, the economic growth numbers, economic growth data will give you an insight into growth in the demand for commodities, and therefore it's extremely important to track economic growth. There are various ways of tracking economic growth. There are leading indicators which are available. I'm not going to all those things, but the point that I want to emphasize is economic growth is critical for those who track the commodity markets. The second one is geopolitics. Geopolitics refers to some kind of political situation, political instability, a warlike situation. And political instability or warlike situation, especially if it were to happen in the Middle East, in the WANA region, West Asia, North Africa region, immediately impacts crude oil prices. And crude oil as a universal intermediate has an extraordinary impact across economies, across geographies, and across businesses. Because crude oil is a universal intermediate, and it impacts cost of production, it impacts transportation costs, and a whole lot of other economic activities. And geopolitics, and in relation to that, crude prices, especially crude prices, actually exert 2 effects. The first effect is oil prices drive industry cost structure. Currently, low oil prices are helping reduce cost of production of metals. And when oil prices were high, $90 to $100 a barrel of crude, the cost structure was very different. And obviously prices were very different. The metal prices, I mean, were very different. But today with a sharp decline in in crude oil prices, it has an impact on metal prices, which obviously are low. The second one is oil prices have an impact on investment decisions. Either they encourage investment in the metal sector, or they dissuade investment in the metal sector. Therefore, oil prices have a twin effect, one of impacting the cost structure of the metal sector, and second, it either encourages or discourages investment. And therefore, it's extraordinarily important for those in the metal space to track crude oil prices and have a view, an outlook on where crude oil prices are moving. The third one is, of course, monetary policy. Monetary policy simply refers to the amount of money in circulation, in very simple layman's terms. And monetary policy over the last 5 or 6 years has had a divergent trend. The US had the monetary easing, a huge amount of printing of the dollars, and that increased liquidity. That resulted in a liquidity-driven commodity boom. While the US Fed, the Federal Reserve started to improve liquidity to kickstart the economy again over the last 4 years, which of course stopped by December 2014, the developing economies, the emerging economies like China and India actually started to raise their interest rate and try to suck out liquidity because inflation control was more important for them. For the US had very low inflation rates, their interest rates were near zero, and there was a huge availability of dollar. That's the developed markets, whereas the emerging markets between 2010 and 2014, and even now, are in fact following what is called a dear money policy. And therefore, the monetary policy is quite divergent. And that again impacts commodity prices. As I said, between 2011 and 2014, commodity prices were high because of high crude prices, high demand because of economic growth, and availability of a huge amount of dollars, which was, I call, liquidity-driven commodity boom. Therefore, tracking monetary policy again is something very important for those in the commodity space. The next one, of course, is currency. I don't have to explain to this very enlightened audience what's the impact of currency on metal prices, particularly metals that are designated in US dollars, whose price is designated in US dollars. When the dollar weakens vis-a-vis other currencies, principally when it weakens against the euro, which is a reference counterpart currency, when the dollar weakens, obviously it pushes commodity prices up. And when the dollar strengthens, which it's happening currently, and it happened the whole of 2015, obviously it caps the upside potential of commodities. And therefore, currency movements, currency dynamics, currency gyrations are important for all of us to track. And last one, of course, is weather. Weather has much less to do with the metals market. It's much more to do with agriculture commodities. But one important driver of metals market is labor action. All over the world, wherever mining takes place, there is always a threat of labor action. And therefore, if you're in agriculture space, look at the weather. If you're in the metal space or energy space or excavation and exploration space, you need to look for signals of labor action which can disrupt supplies and raise prices. And therefore, these are the five drivers of the global commodity markets, which I would think all of us need to track. And where are the key drivers standing now? While these are the five major drivers, and I've said what happened over the last 4 or 5 years, where do we stand now? Currently, the economic growth picture is a mixed one. The signals, the macro data coming from the United States are quite positive. Their unemployment levels are declining, their consumer confidence is increasing, their business confidence levels are increasing, their economic activity is certainly much better than it was, say, 3 years ago. But we can't say the same thing about the European Union or even Japan. China, which has had a scorching pace of growth for the last 20 years, from 2014 has started to slow down. And therefore, the world is today presenting a mixed picture. And China, as we all know, is a mover and shaker of the global metals market, global commodity market and global metal market. And when China slows down, obviously it has a huge impact on metals prices across the world. As I say, if China sneezes, the world catches cold. I think that's the expression all of us know. Therefore, the economic growth is a mixed picture. Demand conditions are not robust. Demand is not in the dumps, really. Let's be very clear. Demand is something just about normal or a little below normal. You take the last 3-year average. But demand is not really robust. And are there signals of an improvement in demand? I think I'll come to that a little later. Geopolitics, crude oil prices have recovered in the last few weeks. They were below $30 a barrel, but they have now improved and are trading closer to about $40 a barrel. And the question is, will this $40 a barrel sustain? Or will it go up or will it go down? My own personal sense is that there is a downside risk to crude oil prices. I think the markets have kind of overreacted and overshot to the upside when they went to $40 a barrel. I'm expecting that there will be a correction and possibly prices could trade between $30 and $35, which obviously is good for consuming countries like India. The question is, if But over the next 3 or 4 years, possibly crude prices have the potential to rise above $50, but not in the short to medium term. Therefore, the question is, if crude prices were to stay around $40 or were to go up for whatever reason, as they call, a rising tide lifts all boats. For if crude prices were to go up, there is a strong possibility that rising tide of the crude oil prices could lift all the boats, including metals and agriculture commodities and polymers and all the entire energy complex. And therefore, we don't know how things are going to pan out. But I am not very bullish. I'm not too bullish about crude oil prices. I'm actually expecting a correction in crude oil prices. It's certainly not going to go below $30. That's for sure. But it could hover in the vicinity of $35 a barrel for some more time. Okay. Therefore, oil continues to remain very crucial to the wider commodity complex, and it will pull other commodities along. If oil prices were to rise, it will lift other commodity prices. If oil prices were to be dragged down, it will obviously drag down the price of other commodities. Monetary policy, as I said earlier, the liquidity-driven commodity boom came to an end in 2015. In fact, by December 2014, when the US Fed decided that the process of tapering was complete and that the policy normalization started, and in 2015 they just about raised the interest rates marginally, the liquidity boom ended actually. But the whole of 2015 and even 2016, the monetary policy of the central banks of the developing economies and the emerging economies are still divergent. While the US is now beginning to raise interest rates, developing economies like India and China are now attempting to bring the interest rates down to once again accelerate the economic activity. Therefore, this divergence is likely to continue for some more time. Currency, yes, all of us know the dollar. I remember exactly this time 2 years ago, 2014, the dollar was 1.38 to the euro. And I recall I was in Cape Town, South Africa, addressing an international conference, and I said by the end of the year, I expect the dollar to be 1.20 to the euro, and that's exactly what happened. But all of us know in 2015 how dramatically the dollar gained strength vis-a-vis the euro and of course the other currencies. And currently it's what, about 1.12 or something? 1.14, yeah. I don't track it on a daily basis. And therefore it's slightly weakened. The peak was 1.08 probably 4 or 5 months ago. It's slightly weakened, but my sense is the strength of the dollar is something which I'm quite bullish about the dollar. It is likely to strengthen, but the kind of dramatic strength that we found in 2015 may not happen in 2016. The gains, the firmness of the dollar would be quite slow and gradual. So the further gains will be slow, and that will have an impact on the emerging market currencies. As the dollar begins to strengthen, there is a strong possibility that the emerging market currencies will have to depreciate. For instance, China. I'm expecting the possibility of a further devaluation in the Chinese currency. It's a possibility, and yeah, welcome. And therefore we need to look at the currency markets and track currencies very clearly. Talking about weather, we had in South Asia last 2 years the El Nino. There's a possibility that El Nino may give way to La Nina, but because this is not an agriculture-related conference, I'll stop here about the weather. Okay. Now, outlook for the metals sector over the rest of the year. Very clearly, fundamentals, market fundamentals, the supply-demand fundamentals, supply-demand balance does not change very rapidly. Given the fact that it takes a long time to invest and produce the commodities like metals, the fundamentals don't change very rapidly, but sentiment can change. And sentiment can change because of any variation in those 5 drivers that we talked about. And therefore, China, for example, which is, as I said, a mover and shaker of the global commodity market and the metals market, has now moved in the last 2 years from what I call investment-led growth to consumption-led growth. And therefore, when China is moving from investment-led growth to consumption-led growth, the composition of the import basket of China obviously has been undergoing very rapid changes. They are now investing much less in fixed assets. The fixed asset investment or investment in construction activity is today, I'm not saying it's declined, the focus is much less on construction activity or fixed asset investment activity than it has been over the last 10 years. And therefore, we need to track what's happening in China, because China is the most critical producer and consumer and exporter and importer of a whole lot of metals. But the Chinese sentiment, I think, reached its lowest level sometime last year. But there are enough signals in the first quarter of this year that I think the sentiment has bottomed out, and probably it's beginning to. I would call that. I would say the Chinese economy, the sentiment-wise, it's now come to the neutral zone. Whether it will move to the positive zone remains to be seen. That would depend on the macroeconomic data that we get in the coming 1 or 2 quarters. Okay. How does the demand for metals look like, particularly base metals? Not really very encouraging. The demand trend, the demand growth is most unlikely to be aggressive given the mixed picture of global economic growth. But the consolation, you can call it even positive news, but I would think it is consolation. The consolation is that the demand trend is not getting any worse. It did get worse in 2015, but it's most unlikely to get worse in 2016 and beyond. If anything, it would improve. And therefore, that's something we need to understand, that in the current VUCA situation, absence of bad news is actually good news. I think that's how we need to look at it. The underlying metal space, the underlying situation, obviously is one of overcapacity. Huge investments were made in production capacities in the last 10 years because of commodity price boom and across markets. And today, with demand concerns emerging, obviously there are mine closures, etc. The impact of which we will know probably 2 or 3 years from now. And at the same time, there are also major corporates on the production side are facing balance sheet related concerns. If we have to kind of mention or capture 2016 in 3 words, I would call it the 3 Ds: destock, divestment, and desperation. Therefore, there will be a huge amount of destocking that will take place in 2016, particularly in China. They have built huge reserves, and therefore they will start to destock. And second, and therefore the demand for goods that contain commodities will continue to remain quite normal, but it will certainly be slightly better than it was 2015. And this destocking cycle that we are in would actually mean that demand growth trends are not going to be aggressive. That's one. And the destocking also means that the raw material trade, global trade in raw material, would not display any major shift upwards in 2016. At the same time, a number of producers are selling their assets. All of them are selling at the same time, but in a market where the buyers are very limited and the financial market concerns are growing now. When you put all these things together, the supply side and the demand side, I think the one country that can make a big difference to the global metals market, global commodity market in general, and the metals market in particular, obviously is going to be China. and the construction or the fixed asset investment activity in China is going to be slow. The government has taken an in principle decision in China. It's asked the construction companies to actually, what should I say? They call this, they run down their property inventory. That's the expression that I read. The government has asked companies to run down their inventories, particularly in lower tier cities, which means the fixed asset investment will not expand rapidly in 2016 and 2017. And therefore, construction activity will be slower than sales and the sale of apartments, etc., etc. Therefore, the impact of which we'll know probably 2 or 3 years later, because there is always a lag between investment, reduction in economic activity, sales, and the impact on the economy. And therefore, I think this is the overall situation. China is the market that we need to look at. Otherwise, global economic picture is not looking very pretty, not very rosy, but it's not poor either. Therefore, we need to we would be facing VUCA situation. There will be volatility, there will be uncertainty, and therefore your trading calls, your investment decisions, etc., will have to factor in the VUCA situation. And therefore, what is important is caution. I think one needs to be cautious, whether in your purchase policy or inventory building policy, or in your sales policy. And therefore, with that note, I'll leave all of you to hear other speakers. Thank you very much. God bless you. Well, it's my pleasure to call Rajni Sinha, Senior Economist, Aditya Birla Group.
Good morning, everyone. Lot of it that I want to discuss has already been brought to the fore by Mr. Chandrasekhar. So please bear with me if you feel there is repetition.
That's the advantage of being the first speaker.
So actually,
thank you very much, Beena. I think next year we'll make her the first.
no, actually I'm glad I'm the second speaker, because there is going to be more repetition, I think, going forward.
Yeah, I think the points need to be hammered.
Yeah. True. So in my presentation, I'm mainly going to look at the macroeconomic indicators and the impact of that on base metal. And very briefly, I will look at India, the domestic industry, what are the growth drivers, what are the regulatory drivers, and what potential does the country offer. The commodity super cycle, which started somewhere in 2003, received a major jolt in the global financial crisis in 2008. And prices, if you see, moved up again in the next few years, 2-3 years, because of all the monetary and fiscal stimulus given by the various central banks and governments. But the rally, the run-up has not sustained. And if you see, in the last 3-4 years, prices have been consistently on a downward trend. And in fact, currently, if you look at the levels, it's close to the bottom seen during the peak of 2008 crisis. Just in the last couple of months, there has been some upturn, and there are increased talks in the market whether, base metal prices have reached the bottom, and from here we could see some reversal going forward. That's difficult to predict right now, but let's look more closely at the factors which have been impacting the industry. As Mr. Chandrasekhar said, the global picture is not very rosy. The global GDP growth is on a downward trend. The IMF is expecting growth to improve to around 3.4% in 2016 from 3.1% that we had this year. But we need to bear in mind that IMF growth projections in the last 2 years have been consistently revised downwards. So actually, it's quite possible that in subsequent quarters, we will see a growth number which is lower than 3.4%. If we look individually at what's happening to the economies, US is definitely showing some signs of improvement. The last quarter, first quarter GDP number which came, it was better than market expectations at more than 2% from 1% that we had in the previous quarter. Labor data is improving, wage income is increasing, but things are not the same for Euro area and Japan. In fact, ECB and Bank of Japan in a desperate measure have gone to negative interest rates. But still growth remains elusive in these two economies. So it will be very critical to see what happens to global growth going forward. Though it's expected to improve marginally, we may not see a significant improvement going forward. China would be very critical what happens to the Chinese economy, given its huge share in global consumption of base metal. Chinese GDP growth, which we were used to double digits growth in 2010, 2011 and before that, has moved now to below 7% level. And China has been consciously trying to move from investment-led growth to consumption-led growth. And that's mainly because of overcapacity in most of the sectors. Another trend which has emerged in China is that the share of services sector is increasing at the expense of manufacturing sector. As you can see in the second graph, the fixed asset investment as well as industrial production has been consistently falling. So both these trends of increased share of services sector and increased share of consumption does not bode very well for the base metal industry. So for 2016, IMF is projecting the Chinese GDP growth to further decelerate to around 6.3% level. But the government there is more or less comfortable with these kind of growth numbers because it's more sustainable in the long run. So for China, we can say that 6 to 7% is going to be the new normal range. But here the important thing that I want to highlight is some of the risk factors in Chinese economy, which can actually cause even further fall. And one big risk factor is the high debt to GDP ratio in China. It's currently at 215%. And if you look at the trend, if you look at the third graph, the trend is upwards. So this is a cause of concern not just for Chinese economy, but I would say for global economy. The Chinese government is working on it and they are trying to deleverage. But in fact, if you look at the data for last 2 months, there has again been a build-up in credit. So which has again raised concern on whether China will be able to control this rising debt. So this graph basically shows what's going to be the impact of China's slowdown on commodity prices. This is an estimate that I have picked up from ADB report, and this basically shows that a 1 percentage point fall in China GDP growth, what would be the implication of that on commodity prices? And as you can see from this, a large part of fall that has happened in metal prices could be explained by the fall in China's GDP growth in the last 4 years or so. Another interesting trend which has emerged and which I want to highlight is that the financialization of commodities has reduced. So we have abundant global liquidity. So we are having phases of risk-taking happening, but it is not having that kind of impact on commodity prices. The impact on commodity prices has reduced of risk-taking in the market. So in the past, if you look at the graph, in the past the stock market and commodities used to move in tandem. But the trend has diverged in the last few years. That's mainly because of capital inflows into base metals as an asset class has reduced. And this trend is also not likely to change in the near future. Talking about currency dynamics and the impact that that has had on base metal, in 2015, we saw a very sharp appreciation in dollar. And that was mainly because US is the only economy which is right now looking relatively better among the major economies. And there was increased expectation that Fed is going to hike rate. So even though only one rate hike happened, in the build-up to the expectation of rate hike, we saw dollar strengthening very strongly. You can see that sharp spike that we saw in 2015. So this had an adverse impact on base metal prices. But going forward, we do not expect that this kind of, this sharp trend in dollar strengthening is going to continue. The strengthening may happen, but it would be very muted. And that's mainly because a lot of strengthening has already happened. And the Fed rate hike has been postponed. And even if it happens, it's likely to be very gradual. So we need not see the same kind of, appreciation in dollar and negative impact on base metals in 2016. The other currency which had an significant impact on base metal was Chinese yuan. So in yuan also in 2015, there was a strong devaluation, which had an adverse impact on commodity prices, including base metal, as that increased that made Chinese import more expensive. So that's why it resulted in base metal prices going down. Again, even for Chinese yuan, I do not expect that there's going to be further sharp devaluation in 2016. One, because China mainly devalued its currency because they were worried about losing their export competitiveness. But if US dollar stops to strengthen so rapidly, there will be less weakening pressure on other emerging market currencies, and hence there will be less pressure on China to further devalue its currency. So the currency dynamics may be more favorable for base metal in 2016. So apart from all the macroeconomic factors and its impact on base metal, another very critical thing which we cannot miss, which was having an impact on base metal, was the supply overhang that we have in the industry. So supply is greater than demand, prices are falling, but supply is also falling, but supply is not falling in accordance with the fall in prices. And that's one reason for that is that the cost of production has been going down because of fall in energy prices and because of weakening in regional currencies. Going forward also, the supply overhang is likely to persist for the base metal industry. So in a nutshell, I would say that global economic growth is expected to improve marginally. There would continue to be abundant liquidity in the system, and there would be bouts of risk taking, and commodity including base metal could benefit marginally from that. But some of the bigger concerns like China's slowdown and supply overhang still persist. To talk very briefly on Indian economy, so currently we are placed very comfortably, I would say a sweet spot at GDP growth of 7.6%. We are much better placed than most emerging market economies. Inflation is under control, interest rates are falling, external factors like current account deficit, fiscal deficit are under control. So the Indian macro picture, even though the global picture doesn't look very good, Indian macro picture is relatively more stable. So this should subsequently in coming years lead to increased consumer spending and investment happening in the economy. Though currently we are not seeing investment picking up strongly, especially in the private sector, but the expectation is that these factors should support a growth in investment and consumption. The other big positive for the base metal industry, which I would like to highlight, is the government's push to the rural sector. So the plan allocation for irrigation, agriculture, Manrega has all been increased significantly in the last budget. So all this should help push up the rural income, and in fact after 2 years of drought, if we have a normal monsoon, that should also help in increasing the rural income, which subsequently should have positive impact on sectors like auto and construction. And obviously the very important development which has been happening in the last few years is government's strong push on the infrastructure sector, roads, railways, ports. So we are having increased, we have increased spending announced for railways, power. Government is talking about housing for all, smart cities, power for all. So all these would definitely have an impact on base metal demand going forward. The regulatory drivers have also turned positive for the industry. So in the last few years, we have been having faster forest and environmental clearances, speeding of project approvals. This is another positive that has been happening. Though there are still many regulatory hurdles in the economy and many bottlenecks, but I would still say in the last 2 years, things have significantly improved compared to what it was, say, in the beginning of this decade. So this is something which should enable increased supply from the industry in the subsequent years. Lastly, I would like to end by highlighting the potential which is offered by Indian economy for the base metal industry. If you look at the first graph, it shows the very low per capita consumption which India has for base metal. So for instance, for aluminium, the per capita consumption is just 1.4 kg, as against consumption of 19.3 kg for China. So this mainly highlights the huge potential that the industry offers. So in the lower two graphs, I've just looked at the demand projection given by CRU for aluminium and demand. These projections, they may change, over a period of time as the macro fundamentals change, the industry and macro fundamentals. But one thing we cannot ignore is the potential offered by the country because of the very low per capita consumption. So going forward, with hopefully with increased urbanization, increased prosperity, and increased infrastructure spending, we should be able to get reality close to the opportunity offered by India. So I would end on that note. Thank you.
Thank you. Thank you, Rajni, for an absolutely comprehensive presentation. I think very interesting and very well said. Just one point that I want to mention is about reduced financialization of the global commodity markets. Very clearly, most funds enjoy playing on the long side, and whenever there is no scope for prices to rise, they withdraw themselves from the market. But there is still enough money floating around in the commodity derivatives market. The peak was 400, the asset under management, AUM, in 2013 was $400 billion, which over 2014 and 2015 declined to about $250 billion. I think it still stays in the vicinity of $200 billion, and there is a lot of money on the short side. Not on the long side, but on the short side, and that's why you find commodity prices so unusually depressed, notwithstanding the demand and supply fundamentals and the inventory overhang that you talked about. For the markets are still financialized. Not to the extent that they were 3 years ago, but there is enough speculative money that's still in this marketplace. Very interesting. Thank you very much for this presentation. I want to invite my friend Naveen Mathur to talk about commodities, currencies, and so many other things that he is known for.
Thank you very much, Chandrasekhar sir. It's been pleasure again on the 8th conference and continuous 8th conference to be part of this particular presentation. Rajni rightly said it's always difficult to be on the 2nd, 3rd and the 4th, and unfortunately I am 3rd. Now, many things have been said in the two presentations earlier. I don't know how much time do I have?
20 minutes.
Okay, that's an easy part. And the other thing is that since a lot has been talked about on the macroeconomics by Rajni, it becomes much more easier than 20 minutes to finish off this particular presentation. My topic is currency and crude oil markets, how they relate to the base metals. Interesting stuff these days. VUCA is the right word which you said for. Uncertainty, volatility, complexity, and ambiguity all rests in the financial markets space and even in the real economies today. Nobody is sure where the economies are headed. And Rajni, from 3.4, the IMF projection, the last Thursday, I think they revised to 3.2% for the global growth. So in January, they said about 3.4% for the global growth. 3 months down the line, they're talking about 3.2% today. Now, this is what the environment has has on the platter for us today. Currency has been very, very volatile. All the subject points have already been talked about. Predominantly, the reason is the Fed. From the last decade or so, from this financial crisis, which started off sometime in mid of 2007, the first cut by the Fed happened in September or October 2007. And from 5.25% of the interest rate, the Fed rate, they went down to 0.25 to 0% range in December 2008. That fast it was, which depreciated dollar, inflated commodities because they're inversely related to dollar, and the end result is, to a large extent, financialization of commodities. Chandrasekhar ji rightly said, $400 billion worth of money was floating around in these commodities. We saw highs touching of gold, maybe safe haven demand, maybe financialization, the weakness of the dollar, all contributed to the highs and highs for all the metal and the commodities in these testing times of economy when everything was in doldrums. So a lot more dependent upon on currency, and particularly for the base metals too, one of the major factor is definitely the currency. Crude oil. Chandrasekhar ji rightly said in the starting note itself that crude oil is a double whammy. One way, it affects the cost of production for the base metals. The production costs go up, therefore the prices of commodities, particularly the base metal pack or the industrial commodities, go up, major contributor as a raw material. At the same time, the second effect also is a better effect for the countries like India, wherein your macroeconomic situation further strengthens because of the subsidy and the the import outgo which you do, and which actually affected our CAD. So both these, the currency and the commodities, the crude oil particularly, affect the base metals largely. This is the content of my presentation. You may see lot much has been duplicated, but for the sake of simplicity, I'll run through with all the slides and enforce whatever I can to add upon the two first speakers. The Fed, 2008 till 2016, or I should say 2015. Both sides of cycles have happened, from 5.25% of the Fed rate, highs on that level, to 0.25% of the range in December 2008. From that point till December 2015, 7 years, the Fed didn't touch the interest rate. They went on to the loosening policy. They went on for a quantitative easing, 1, 2, or 3. They went on to make the monetary policy so loose that the economy grew. Fortunately, that happened in the US in 2010 itself. It came out of the recession in March 2009, if I'm not mistaken, and 2010 onward, it's on the growth trajectory. So from that point, when the unemployment rate in October 2009 was 10.2%, today it is sub 5%. And that was the reason prompted Fed to start thinking about tightening the policy. December 15, they did 25 basis point hike. And mind you, in December 15, they said they were going to do the aggressive tightening to the 4 times in 2016 as a calendar year. That's what the projection came up. Although it was gradual, they said that they're not going to go on a flyer for this interest rate hike because they are aware of the problems in the global economy, but at the same time, they were still aggressive. Today, as we stand, we are talking about 2 times of the interest rate hike in 2016 as per the last projections. So just 3 months and so much of a change. So volatile, so ambiguous, so complex. We all know about China. Not much has been said about. 6.7% is what the first quarter of this calendar year, the GDP figures came up, versus the 6.8, which was the last quarter of 2015. Kind of stabilization, rightly said by Mr. Chandrasekhar, a neutral zone from the negative zone. Stabilization. Manufacturing figures, the services figure which were released last week came slightly positive. As per the expectation, not on the downside. Even as Rajni said, the government is happy at 6.5 to 7% of the GDP because they're leading the investment-led growth to the consumption-led growth. They want it to be long-term rather than being short-term on double digits for 3 decades. One of the major factors. In 2 presentations, sir, I take this opportunity. One of the uncertainty which we missed out is Britain on June 23rd. Referendum. Now, that's a very critical aspect for the EU, which is one of the largest importers today, except for China. 23rd of June, the Britain will go to a referendum whether they want to be in the Euro or not. They want to be in European Union or not. Euro itself has taken its own weight in 2014 and 2015, and I would say from 2012, 2015, because of the sovereign debt crisis. We saw talks about Greece, Spain, Italy, France from 2012 till 2015. Here we are again in 2016, June, that one of the largest countries, although they don't have the common currency as euro, but they are part of the European Union, and with this European Union trade facility, freedom of trade, movement of labor, much of things would change if they choose no. Greece, again, is a problem in this summer. Will be a problem this summer. There are conflicts between IMF and the debt institutions. Germany doesn't want to give debt relief. They don't want for the countries like Greece and Spain. So euro would come into the limelight sometime in summer season of 2016, which we must watch cautiously. From sub $30 levels in January to around $40, $42 levels today. Brent is around 42, WTI around 40. Not much has been said about, we all know about this industry, why and what are the reasons for the crude oil to be on these kind of downside trajectory. 2014 onwards, June, I remember $114 levels, today at around 40, and we have seen good $23, $24 sometime in January 2016. It has bounced back. One reason is for the simple currency factor, which weakened and therefore it increased the prices in the dollar terms. The second reason is, what I understand from whatever material I'm reading, the production has somehow been curtailed in the US. The shale revolution, which took toll on the crude oil prices, has somehow weakened. Some 86 rigs have closed down, and from a highs of 10 million barrels a day production, they have come back to around 8.5 to 9 million barrels a day. That 1 million barrel kind of does not make too much of a difference with Iran coming up for 3 million barrels a day after the sanctions have lifted. So what Mr. Chandrasekhar rightly pointed out, we are not too bullish on crude, but I think a slight different view here with around $40, not the $35 where the crude should sustain. Even if, sir, the Doha Sunday meeting did not happen too much in positive for crude, but we are seeing prices holding at around $40, $42 levels. So crude oil is something to watch out for. Currency is something which is definitely for the commodity space to watch out for. I'll skip this line. $64% is in dollar, the trades foreign exchange reserves. We all know about the reasons why the dollar has moved on the upside and why it is now getting weakened. Now, this graph actually shows the pictorial representation. The red line talks about the dollar index, and The global Goldman Sachs commodity index is on the blue line. Can you see this inverse correlation so easily on it? Dollar weakens, copper prices moved up. $5,000 we crossed, sitting at around $4,900, $5,000 levels today. 5,300, 5,400 is what we have seen copper prices moving on the upside. So one of the major characteristics of the dollar-denominated commodity is this part of the currency. Mainly for jewelers, bullion performance vis-a-vis the dollar index in the last 4 years. Interesting. From 2012, if you see, till 2016, the base metals, which are in red line, and you see the dollar index, such a great correlation, inverse correlation on the prices. But does the currency only a sole determinant? No. In the first 2 slides of Mr. Chandrasekhar, he has spoken about various factors. Currency was one of the factors. Demand and supply dynamics, crude oil, other things which are geopolitics, which is China factor, which are emerging markets factor, which are America economy factor, the Eurozone factor, the labor actions, and particularly for the base metal industrial commodities, I think one of the strongest thing is on the demand and supply, which affects is largely the labor actions. We have seen a couple of mines going out berserk, out of the mining activities because of the labor actions, which really take the prices on the upside. So it's just not the currency, the other factors too. I think 5 minutes I have, sir? Please. Yeah. Now this is a relation between crude oil and base metals. If you see 2015 onwards, the prices of both the commodities, the base metal pack and the crude oil, have started declining. The reasons we all know: ample supplies, dollar strength, and all that reasons. China factor, which impacted largely base metals. 40% of the consumption, which we all know, comes from China. 40 to 50% of the entire base metal pack comes from China. Self-explanatory slide, nothing much to talk about. 21% fall in prices of copper. Nickel has been the worst performer on the LME by 42%. It has fallen. Not many things we all know. 12-year low, nickel in 2015. Slowing demand from the Chinese stainless steel industry, which is a core industry for nickel consumption, has fallen. And what we expect the prices to be kind of a range bound, not too much on the lower side, because China is stabilizing. Doesn't look like to be that the China will be in doldrums too much. Their services sector has improved. Their fixed assets to investment, what they're looking forward to, is going down. Except for the Eurozone, rest everything is falling in place. And therefore, we feel not too much on the downside, but yes, 4,500 for the dollar copper prices. Approximately, aluminium would be around $1,300 on the downside maximum, but restricted upside, so maybe pretty much range bound for the prices to come on to. Thank you very much.